You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, last week we took some time off to answer some listener questions. And you know what? Earnings is kind of sneaking up on us. And I've just realized that FedEx, $250 some odd stock, is going to be announcing earnings. And if you are a frequent listener to Options Playbook Radio, you know some of my favorite underlyings are just more expensive underlyings, not necessarily because of the companies that have high stock prices. It's just if the underlying stock has a higher valuation, there is more premium in the option contracts to play with, just in general. And because of that, it allows you to manipulate some strategies and deal with time premium. And then you throw in an earnings forecast on an expensive stock, and then things get really interesting. Okay, so today we're going to look at FedEx. FedEx is going to announce earnings here on the 19th of June. And today happens to be a Wednesday, the 6th of June. So we're actually going to use a diagonal trade around the earnings. We haven't done a diagonal on Options Playbook Radio in a while, but I like to use diagonal trades or calendar trades when a company is going to announce earnings a few weeks out or even a month out, depending on the underlying and depending on the volatility. So today the markets are closed. It's Wednesday, June 6th. This is when we're taping Options Playbook Radio. You'll be listening to this show on Thursday. But we're going to look at FedEx based off of the information that they have a pending earnings announcement after the close on the 19th of June. So FedEx today had a big run up. It closed at $256.55. up $4.55. We're going to look at a diagonal spread by buying the expiration that contains the earnings and selling an expiration that does not contain the earnings. If you'd like to learn more about the diagonal spreads, you can hit pause right now. And if you have an Options Playbook on your table, you just turn to page 96 inside the playbook. But don't fret if you do not. You can always just go to optionsplaybook.com and click on the strategies tab, and you will find a diagonal spread in there. The diagonal spread that we're going to deal with is specifically with calls. Now, you can always do it directional, as with everything on Options Playbook Radio. It's never meant to be a recommendation. So if you flip a coin, you want to be bearish for your paper trade, go ahead. I'm going to be bullish in this instance. And as always, this is not meant to be a recommendation. We're just trying to learn. The biggest thing about Options Playbook Radio, and I think the biggest challenge that I have, is that a lot of times I come up with a strategy and I need to look for an underlying to do that. And most people pick the underlying and then go out and pick the strategy. But we try to find as many situations that seem to be okay to do these strategies in. And we have a lot of them to pick from inside the options playbook. So without further ado, we are going to do a bullish diagonal spread in FedEx. Now, it's going to start out neutral and to bullish. In other words, ultimately, we'd like it to be bullish. But when it's all said and done with this underlying, we are going to be bullish on FedEx going into earnings. So here's the trade. Then I'll explain the dynamics of it and why I chose the strikes and why I chose the expiration. We are going to sell the June 8th expiration FedEx 257.50 call, and at the same time buy the June 22nd expiration 260 call. So the June 8th expiration only has 2 days remaining until expiration, and the June 22nd has 16 days remaining to expiration. Now, the June 22nd is the closest expiration date to the actual pending earnings announcement on the 19th, which means the implied volatility is higher on the June 22nd expiration than on the June 8th expiration. If we're doing this trade, and the reason why I set it up this way, where I'm buying the higher implied volatility and selling the lower implied volatility, is that I expect the June 22nd volatility to increase as earnings approaches. So right now, my forecast on volatility is that that month will go up. And it is trading at a 27% implied volatility on the option that we are buying. And it's trading at a 20% implied volatility on the option that we are selling. So if you think about a diagonal spread, a lot of people try to think about what they want to happen to volatility when you're dealing with multiple expirations. But the concept is that with any type of spread like this, that you're selling one option and buying another option in multi-months, what you really want is the front month option to go away, and then that leaves you a long option contract. Now, if you close it all out prior to expiration, so be it. But if the front month option expires worthless or fairly close to at the money, that would be the ideal scenario. In that situation, you just are left with a long option contract that's got more days remaining. And what do you want to happen to implied volatility? You want that to increase. So this trade overall is actually going to be kind of a two-part trade. The fact that it is an expensive underlying allows us to do something creative with it because there's some juice in the option contract. So we're buying the 260 call option, which is out of the money, considering the market right now is at 256.55. It's quite a bit out of the money in this instance. And it's trading on the, and we're just going to talk about the midpoint of this at about $4.40 on the mid. The one that we are selling is trading at about $1.15 on the mid. The actual mid, if I do this entire trade, is $3.20. $3.20. And if you go out to the first expiration date, that is going to be your max risk, which is that net debit paid for this position. $3.20 times 1 by 1 is $320. And you always have to remember to add commissions when you're doing the trades. Okay. So why do I like that this is an expensive stock, $256? The fact that I have 2 days remaining until expiration, and I can go, it looks like about $1 out of the money on FedEx and still receive $1.15 for that call option is attractive to me. So my ideal scenario here is that the market on the front month, on that front month option, just the stock doesn't make it to 27.50 and it expires worthless. And then that just leaves me long a call option, which means in 2 days time, I have the ability to either sell the long call, stay out of the position. I have a cheaper long call just overall because I was able to lower my cost basis by selling a front month, or I could actually go out and either roll that option to the next week because there's a June 15th expiration, or if it just flat out expires worthless, I can go out and just sell another June 15th expiration, either at the same strike, or I could go out and sell one at the strike that I am long, the 260 strike call options. So this just leaves me a lot of opportunity in this diagonal spread. Okay, so let's recap the trade. We are going to sell the June 8th expiration 2750 call that has 2 days remaining to expiration. And then we are going to buy the June 22nd expiration 260 strike call, which is a little bit further out of the money, that has 16 days remaining to expiration. So I put this trade on. What would be the ideal scenario here? Well, I carefully picked my strikes to make sure on the diagonal trade that the deltas were similar. If on the front month, I am selling a 41-cent delta, and on the back month, I am buying a 42-cent delta. That's extremely close. And here is what ideally would happen, is that the market would creep up to 257.50, or the short strike. We would just like it to creep up. There's only a few days remaining. So we'd like it to get to 257.50, or ideally 257.49, right? 1 cent out of the money. We don't even want it to be pinned at it. We would just like it to be there at the expiration of the June 8th contract. If that happens, well, we should basically be flat on the trade because we bought as much delta as we sold. Now, it's a dynamic number and it will be changing, and you got a real market and you got implied volatilities moving too. But in theory, we're delta neutral now on this trade. If the market goes down and it goes way down, well, that's a bad thing because ultimately we are just going to be long the June 22nd 260 call option. So if it's going down, we can choose to just get out of the position if you'd like, or you can let it ride. But you have some exposure here in that you have $321, which is our net midpoint on the entire trade. So that's fairly expensive. Some people might want to say, if I'm down 50% on that, I'm just going to get out. But if the market stays where it's at, or it starts creeping towards the short strike of 257.50, well, that's the ideal scenario. Okay, so in 2 days, let's say the market's at 257, right? Just below the strike price. That's a really good scenario in this instance. Then what we might do is go out and sell the June 15th expiration. That's the ideal scenario. We can bring in some more premium. But if I'm going to sell the June 15th, I'm probably going to turn this into a calendar spread. And I'm going to sell the 260 call on the June 15th, 9 day away currently expiration, and then just remain long my June 22nd expiration. That would not be a bad scenario. And then if the stock gets to 260 in that instance, now I got a pretty good winner because I've already captured the $1.15 from the first option contract, and then I should be positive on the second option contract. Okay? So another bad scenario would be if the market just cranked and it went all the way up to 260 before this Friday expiration. We do not want that because the front month delta is going to skyrocket in that case, and the back month long option contract won't keep up with it. So if the market hits in FedEx my short strike in a diagonal 257.50, if it hits that, which is right now about a point away, if it hits that number, I'm just going to close and get out. I'm not going to allow the stock to get in the money on my front month option contract. So I'm setting an alert right now. I placed the trade. I have a net debit of $3.21, $321. Then I set an alert and say, hey, if FedEx gets to $257.50, I want to know. And then I'm going to go in and close my trade. I should be pretty much flat on it. But I'm really hoping by selling such a short-term option contract, the fact that it's got so much juice still with only 2 days remaining, I'm really hoping that just expires worthless and I got a cheap call on the upside. The fact that FedEx was up, had a pretty big move today, $4.55. That helps things in this scenario. I'm hoping that the stock will just kind of slow down and just kind of hang out and wonder what's going to happen with the earnings out at the June 19th date when that announcement's going to happen. So that's my plan. That's my forecast, is that I'm a little bit bullish, but right now I'm bullish but neutral, right? I really want the stock to just hang around where it's at for the next couple of days. All right, so that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com, at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. We'll keep an eye on this FedEx trade to see where it ends up at. And until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.